So Donald Trump, U.S. President Trump, declared there was a ceasefire in the Middle East, and then a missile was fired into Israel. Initially, after the Americans attacked Iran on the weekend, oil shot up, but it's been dropping ever since. So are investors just ruling out a risk to crude supply? That's what our guest thinks. We're joined by Reid I'Anson, economist at Kpler. Reid, great to see you. Thanks very much. So you think right now the supply risk premium has gone out of the oil market?
Yeah, pretty much. I mean, if you look at the movement in just spot Brent oil prices, we're basically back to levels before Israel moved on Iran 10 days ago, right? We're trading around this $67 per barrel level. And so at least, you know, if you watch what the market is thinking, it's really focused on the path of de-escalation. And of course, we've even seen today in Washington, Trump continuing to push this narrative of a potential ceasefire. And even though there was maybe a break from that agreement earlier today, again, it looks like there may be some momentum on that end. So again, I think that the core narrative right now in the oil market is one of de-escalation.
You are also broadly pessimistic on oil. You think that the price will come under pressure even when and if things calm down in the Middle East?
Yeah, of course, we saw that big rise in oil prices because of a risk of supply disruptions. You know, keep in mind that the Strait of Hormuz accounts for 35% of global seaborne oil flows.
35
so
is... sorry, we keep hearing 20. Sorry to interrupt you, Reid, but it's closer to 35%?
Yeah, if you're just looking at the seaborne-only side of the market. If you're looking at total global, it's 20%, but that seaborne side, it is 35%. So very large. So, of course, you know, the market was trying to come to grips with, you know, if that were to be closed, we're going to sell oil higher here. But, of course, we're you know, in this period of potential de-escalation, so we're seeing prices come off. Of course, keep in mind that we are in this broader oil market environment that is oversupplied, right? If you go back to pre-Israel strikes, you know, we were looking at an oil market that is set to be very oversupplied by the end of this year. And, you know, we've seen a large build in global oil inventories. So, again, I think over the medium term here, the drive is still probably for a lower oil price, especially if we move through this period of conflict in the Middle East.
Is that partly because OPEC Plus is increasing production?
Yeah, exactly. Bringing a lot of additional production on the market. And we're not yet seeing a lot of U.S. production come off the market. That could potentially happen next year. It's probably one outcome OPEC is hoping for. But again, that's probably not going to come until some point next year. And so again, we've got OPEC pumping a lot of additional oil. And of course, on the demand side, things have softened given, you know, chaotic Trump tariff policy. So again, the demand side not looking great and a lot of additional supply. It's just equating to a pretty oversupplied market.
And what is your forecast? I mean, we saw Brent in the last 24 hours dropping below $70 US on optimism that a ceasefire is holding between Iran and Israel. What would your forecast be for Brent, the world quote on oil?
Yeah, so I think the summer, you know, the next 2 or 3 months, the market will be somewhat more balanced because of we are in that seasonal strong point for demand. So I think that Brent maybe holds in a range between 67 to 72, with that 69 level as kind of an anchor. But again, I think by Q3, we probably see a break to the downside as the oversupply conditions really start to come back into the market here.
And are you in the camp that thinks OPEC Plus is increasing production because the Saudis are, well, ticked off at nations that are cheating, but also worried longer term about losing market share?
Yeah, it's a key. Both of those are key narratives. And you'll notice when they started to bring oil back into the market was kind of when we were heading into this period of seasonally strong demand. So again, maybe not a great environment on average for 2025 to be bringing production back. But if you're going to do it, you know, that May, June period or a little bit earlier than that was kind of the moment when you wanted to do it within the year.
It's interesting. the segment producer, Ali Juwani, showed me a CNN article, and it says America's economy faces a potential war shock, surging oil prices. But your contention would be oil would need to get up around $90 US before there would be a significant inflationary shock.
Yeah, the reality is we saw such a large sell-off in oil prices through the first half of the year that there was just a lot of cushion before we would really see oil prices as a big-time inflationary force. Consider that if you just look at the average oil price through the month of June, even accounting for the surge that we got, oil prices, WTI is still lower by 14% relative to last year. Right, so maybe that deflationary effect eases off a little bit, but we're nowhere near territory where prices are surging above year earlier levels, right? And again, I think we would likely need to see WTI around 90 for 2 to 3 months before you'd really have a strong inflationary impact on U.S. headline inflation.